This material is created by EasyPathUni by Cordations with Yazan Ibrahim. And speaking of incredible minds, joining us on this deep dive is an expert who has really lived and breathed the world of corporate finance.
It's great to be here.
You bring just extensive professional experience, including leadership as a head of audit for a financial department, which is fantastic.
Thank you. Yes, I've spent quite a bit of time in the trenches, so to speak.
And your deep expertise in audit, risk management, financial analysis, it's all underscored by, well, a really solid educational background and an impressive range of certifications, things like CISA, CFE, GRCP, GRCA, FEPA, FMVA, CBCA, BIATA. It's quite the list.
Well, lifelong learning is key in this field, isn't it? Always evolving.
Absolutely. So it's safe to say we have the perfect guide for today's journey into the heart of financial decision-making. Welcome, everyone, to the Deep Dive, where we extract the most important nuggets of knowledge from the sources you need to understand. Today, we're plunging into the fascinating world of how organizations actually manage their money.
It's a critical area.
Right. Our mission is to give you a shortcut, really, to being well-informed about the critical choices companies make. We're talking investments, funding, how they navigate risk.
All the big questions.
Exactly. Our exploration today draws heavily from key excerpts of financial decision-making, capital structure, and risk. So if you've ever wondered what truly drives corporate success, from a financial perspective, and you're looking for those deeper insights beyond just the definitions, well, you're definitely in the right place.
Okay, let's unpack this. So kicking us off, the core idea running through our source material, it seems, is that financial decision-making isn't just part of effective corporate management. It's absolutely at its heart, the engine, really.
It absolutely is. And what's truly fascinating here is why it's so central. It's not just about making money, though that's obviously important.
It's about strategically choosing the best courses of action to achieve those big overarching financial goals. Every significant decision involves this calculated balance between potential risk and what you hope to gain, the anticipated return.
Balancing act, always.
Always. And crucially, these choices must align just perfectly with the broader strategic objectives of the company. Think about it. These choices ripple out. They impact every single aspect of a company's day-to-day operations and, maybe more importantly, its future path, its trajectory in a really competitive market.
Which brings us, I think, directly to our first major deep dive.
Yeah.
Capital budgeting. This is all about investing for the long haul, right?
Exactly. The big bets.
Yeah, when we talk about capital budgeting, we're not discussing, everyday expenses. We're looking at how companies evaluate and select those massive long-term investments, the ones that require substantial capital.
Huge amounts of capital.
Things like building new factories or buying that expensive cutting-edge machinery or maybe launching major multi-year R&D projects. Here's where it gets really interesting, I think, because these choices really define what a company can do in the future.
Indeed. And the process, well, it's actually remarkably structured, or at least it should be. It's designed to minimize guesswork.
Okay.
It usually starts with identifying potential projects, sort of scouting for those investment opportunities that don't just seem profitable on the surface, but also genuinely support the company's strategic goals.
Makes sense.
Then, once a potentially viable project surfaces, the next, and you could argue most critical, step is evaluating it rigorously, using specific financial analysis techniques to assess its feasibility and profitability well before any significant capital is actually committed.
And for our audience, many of whom are probably familiar with terms like net present value or internal rate of return, the deeper insight perhaps lies in how these are practically applied. And what are the nuances or pitfalls?
That's a great point. Take net present value, or NPV. It discounts all those expected future cash flow back to their present value. So you can compare apples to apples, today's investment cost versus future returns in today's money.
Right.
The core principle is simple. Positive NPV projects theoretically add value, but a common pitfall.
Yeah.
Assuming your forecasts of those future cash flows are perfect, real-world projections are always, subject to uncertainty. Estimation is hard.
Always.
NPV's strength is its direct link to shareholder wealth, absolutely. Yeah. But its weakness can be that sensitivity to your assumptions, which is partly why companies also look at the internal rate of return, or IRR.
Okay, so how does IRR fit in?
Well, NPV gives you a dollar value added. IRR gives you a percentage return. Often more intuitive for managers, right?
Yeah.
It's the discount rate where the project's NPV hits exactly zero.
The break-even discount rate.
Precisely. So if a project's IRR is higher than the company's cost of capital or it costs them to get funds, it's generally seen as attractive. But IRR isn't perfect either. It can sometimes give misleading signals when you're comparing mutually exclusive projects, or if the cash flows are unconventional, like negative flows later on.
So it's not always straightforward. What about something simpler, like the payback period? It seems almost too basic sometimes. Just how long does it take to get my initial money back?
Exactly. It is conceptually straightforward.
Uh-huh.
But its value isn't really in assessing overall profitability. It's more about liquidity risk.
Ah, liquidity. Okay.
Yeah, companies that are maybe short on capital or are operating in really volatile environments, they might prioritize getting their cash back quickly. So a shorter payback period is attractive, even if a longer-term project might actually offer a higher NPV down the road.
So it's a quick screening tool.
Kind of. Useful for assessing how fast cash might return, but it ignores profitability after the payback point. Which is why, ultimately, the smart approach is using a combination of these techniques. NPV, IRR, payback, maybe others too, not relying on just one.
Right, get a fuller picture.
Exactly.
Yeah.
It helps ensure you're allocating those scarce resources efficiently, moving beyond just gut feelings to a more data-driven approach that explicitly factors in risk.
Yeah.
And again, that strategic alignment we talked about.
Okay, that makes sense. Moving on then from where companies put their money, let's maybe transition to how they get that money in the first place.
Capital structure.
Yes, capital structure, which is all about that crucial mix, right? The blend of debt and equity a company uses to fund everything it does, its operations, its investments. So the big question for any CFO isn't just how do we get money, but maybe how do companies find that optimal mix, the one that really maximizes value?
Yeah, it is indeed the million-dollar question. Maybe the billion-dollar question for some companies. And it's dynamic. It's not a static formula you just calculate once. The optimal capital structure, in theory, is that sweet spot. It's where a company minimizes its overall cost of capital, usually measured by the weighted average cost of capital, or WACC.
WACC, right.
But what's fascinating here isn't just the math of minimizing WACC. It's understanding how companies are constantly weighing the benefits of, say, cheaper debt against the risks it introduces, all while trying to maintain financial flexibility in a market that's always shifting.
So it's a constant balancing act.
The continuous balancing act.
Yeah.
Because a lower WACC directly translates, theoretically, to higher firm value.
Yeah.
So getting this balance right is absolutely paramount.
So beyond just the WACC number itself, what are the key considerations? What factors are they constantly juggling?
Well, beyond the pure cost of capital, a huge factor is risk tolerance. How much risk is the company and its stakeholders willing to bear? Companies have to carefully balance the benefits of debt, like the interest payments often being tax deductible, and debt usually having a lower explicit cost than equity against the increased risk of financial distress. Potentially even bankruptcy if debt levels get too high.
Right, the dark side of debt.
Then, market conditions. They play a massive role. What are the prevailing interest rates? What's general investor sentiment like? How accessible are the capital markets right now? These things heavily influence choices. You might want debt, but if the market's not receptive, you might have to issue equity.
True.
And finally, something crucial. Financial flexibility. This is huge. It's a company's ability to access funds quickly when needed, to adapt to changing circumstances, or perhaps seize unexpected opportunities. You never want your financing structure to paint you into a corner.
Flexibility is key.
Absolutely. And this whole optimal capital structure concept is particularly nuanced because it is a moving target. Too much debt, for instance, significantly increases financial risk. That higher risk makes shareholders demand a higher return, which could actually push your stock price down.
Interesting paradox.
Right. Conversely, too little debt might mean you're missing out on those tax benefits or the chance to leverage growth using cheaper capital than equity.
So there are other factors influencing this debt versus equity choice, too.
Oh, definitely. The relative cost of debt versus the cost of equity is always a consideration. Tax deductibility inherently favors debt in many places, as I mentioned. Business volatility is critical, too. Companies with less predictable cash flows usually favor more equity. Because debt payments are fixed, they don't care if you had a bad quarter.
Right, gotta cut those payments.
Got to make the payments. And finally, a company's growth prospects. High-growth companies often need more equity to fuel that rapid expansion, especially if their current cash flows can't yet support significant debt servicing.
Okay, so a lot of moving parts in capital structure. Now, threading through all of these big decisions, investing, financing, there's something else that has to be constantly considered. risk management.
Absolutely essential.
Yeah, this isn't just some separate department or a compliance checkbox, is it? It feels like it's an integral part of all financial decisions, from those huge investments down to daily operations. If we connect this to the bigger picture, it's fundamentally about protecting the organization, right? Safeguarding it against the unpredictable.
Precisely. It's about survival and resilience. Organizations face all sorts of financial risks, and just understanding them is the first critical step. You have market risk, for example.
What's that cover?
That stems from fluctuations in broader market factors, things like interest rates going up or down, foreign exchange rates shifting, or even commodity prices changing unexpectedly. Imagine a company that imports raw materials. If the currency exchange rate moves against them, their costs can jump overnight.
Right, uncontrollable factors.
Exactly. Then there's credit risk. That's a risk that someone who owes you money won't pay. Could be a customer, could be a borrower, any counterparty defaulting on their obligations. Think about a major client suddenly going bankrupt and being unable to pay their bills. That hurts.
Definitely.
And finally, you have operational risk. This is a broad category covering failures in internal processes, systems, people making mistakes, or even external events like fires, floods, pandemics, things that disrupt the actual business operations. It's really about protecting against, well, the known unknowns, and even trying to prepare for the unknown unknowns.
So for our listeners maybe thinking about their own companies or investments, how do effective organizations actually manage these complex risks? What are the key strategies? It can't just be crossing your fingers.
No, definitely not. It starts with systematic identification and assessment. This means meticulously cataloging and evaluating all the potential risks a company faces. What could go wrong? How likely is it? What would the impact be? And this isn't a one-off exercise. It has to be ongoing.
Constantly scanning the horizon.
Exactly. Then comes mitigation. Once you know the risks, how do you reduce them or their impact? Companies use various tools here. Diversification to spread risk across different areas. Hedging using financial instruments like derivatives to offset potential losses from market swings, or sometimes simply buying insurance for specific threats.
Okay, practical tools.
And critically, it's a continuous loop. It requires constant monitoring, tracking those risk exposures, reassessing their probability and impact, and adapting your strategies as conditions inevitably change. The world doesn't stand still.
Very true.
And the benefits of doing this well, of having robust risk management, they're profound, really. First, it protects against those unforeseen losses that could cripple a company. That's paramount for survival.
Sure.
It also directly supports long-term sustainability and growth by creating a more stable, predictable environment for planning. And it certainly enhances stakeholder confidence. Investors, customers, employees feel better knowing the company is prepared. It builds resilience.
Which really raises an important question for any organization, doesn't it? Are they truly being proactive in protecting themselves or just reacting when things go wrong?
That's the key question. Proactive versus reactive.
And that proactive protection, it surely extends down to the day-to-day stuff, too. Beyond the really big picture investments and financing, financial management also dives deep into the short term, right? We might not deep dive into it today, but working capital management seems crucial for just keeping the lights on efficiently.
Oh, absolutely. Working capital is the lifeblood of daily operations. It's all about managing those short-term assets like cash, inventory, accounts receivable, and short-term liabilities like accounts payable. The goal is to ensure the company has enough liquidity, enough cash for daily needs, while also trying to maximize returns on those assets.
It sounds like another tightrope walk.
It is. It's this constant balance between having too much idle cash just sitting there, earning nothing, versus not having enough cash to cover immediate obligations or maybe missing supplier discounts. Efficiency is key.
And I guess tying all these different pieces together, the long-term investing, the financing mix, the risk management, the short-term liquidity is strategic financial planning.
Exactly. That's the glue. Strategic financial planning is where all those individual financial decisions get aligned with the organization's big long-term objectives.
How does that work in practice?
Well, it involves detailed budgeting and forecasting, trying to anticipate future performance and resource needs. It also includes rigorous scenario analysis planning for different possibilities. What if interest rates jump 2%? Or what if our main competitor launches a disruptive product? Or what if key supplier goes bankrupt? Preparing for different futures.
Planning for contingencies.
Right. The ultimate goal is ensuring overall alignment. making sure every dollar spent, every dollar raised, every risk managed is actually pushing the organization towards its long-term vision and strategic goals.
It's so clear listening to this how interconnected it all is. A company's financing choices, for example, directly affect how much it can invest in those capital budgeting projects.
Absolutely.
And robust risk management, well, it underpins both the investment decisions and the financing strategies. It creates this complex dynamic web where really every thread impacts the others.
Perfectly put. It's a system.
So, what does this all mean for you listening in? Our deep dive today, I hope, has shown that understanding financial decision-making goes way beyond just memorizing definitions.
It's about the why and how.
Exactly. It's about recognizing that good capital budgeting ensures investments aren't just hopeful punts, but are strategically sound and financially viable, really driving future growth. An optimal capital structure isn't some fixed number found in a textbook. It's dynamically managed to minimize costs and maximize value, giving a company the strongest possible financial foundation.
A constant process.
And effective risk management isn't just a safety net for when things go wrong. It proactively safeguards the organization's financial health against those unforeseen challenges, building that crucial resilience.
Right.
And overarching all of this, that strategic alignment we just talked about, and the ability to adapt, to be flexible, those are absolutely essential for long-term success in the pretty dynamic business environment we all operate in today.
I think the enduring takeaway really is the continuous vigilant need for financial managers and, frankly, leaders at all levels to weigh risk and return in every single decision they make. It's constant.
Yeah.
They have to constantly align these decisions strategically with the company's bigger goals and, maybe most importantly, remain highly adaptable. Things change fast. It's this ongoing, sometimes really challenging, but always critical process that truly drives sustainable value and long-term success for any enterprise.
That's a great final thought. So as you go about your day, maybe think about how these profound financial principles influence the companies you interact with, from the global giants shaping markets down to the local businesses in your own community. Understanding them, even at this level, can truly reshape your perception of the business world. It gives you a powerful new lens, really, to see these strategic choices being made every single day. Thank you for joining us on this deep dive.